Welcome back, everyone. We're back for part 2 of How to Think About Investing. We're back with Steve, and I'm assuming he's all right.
I'm still breathing.
They're still around. Today, we're going to follow on from the basically the last episode of, and we're going to talk about value of information. I'm stuttering to start with. You're making me nervous.
We're going to talk about basically this one is. When we talked about risk, we talked about personality and that sort of stuff. This one is more about market knowledge. And because, as you know, the daily chatter out there is, you can read the Fin Review every day, but does it really tell you anything?
Well, that's so important. Like how to, I think by the end of this one, if we can give people at least one thing to do that helps them filter the noise, then we've done a good job.
Yep.
So let's talk about that. So we'll start with kind of prior information and specific evidence. We've got the slides on the website here as well if you need them. What are we trying to say here? There's 3 types of information.
Yeah, it's what I'm trying to say here is you want to look at this thing called base rates, okay? And I think there's a slide coming up on it. But the base rate is the average stock returns around 8%.
Yes.
That's what they call the base rate, okay? Now, sometimes it'll be 12, sometimes it'll be 4, but the long-term average is 8, and that's the base case, right? Base case of men's height is about 5'10", righto? Now, there's no skill involved in getting the average return.
You just buy it.
Buy stocks, wait forever, and you'll probably end up with 8%, right? And that could be a bull market of 16 and a bear market of 0, right? Okay, so the next part, but that's important to know because if I said to you, Jacob, you're going to yield 2%, you're going, okay, well, you said, Steve, I should get 8 as an average. And I'm saying, yeah, Jacob, because you're paying 3 times as much.
Yes.
You then go, okay, I don't think that's a good idea. I'm going to wait till Steve comes back and says, Jacob, I'm offering you 12. And you go, cool, it's really cheap. So that 8 is a sort of anchor point.
Yeah,
right?
but then you want to go and drill down into what's the individual knowledge.
Yeah. So you might say, oh, Steve, I think indexes suck. I want to buy a company, right? Or I want to buy an individual property.
Yep.
Okay. Then you got to get more specific and say, okay, get the base rate, get that. What about this company or this property will deliver me more than 8? Okay, well, Jacob, it's because it's close to schools and shops and the government's going to build a road and, roads historically mean your value goes up, blah, blah, blah. Oh, right, okay. That's specific information about the investment. Rio Tinto's really cheap because iron ore's depressed at the moment. We're expecting it to rise more. The PE's 13. Look, we think it'll go really well. Oh, okay, I'll buy Rio, right? But again, you take a step down into more information about the specific investment, right? So it's no good saying, oh, the property market's rising, everybody's making money, okay? Because the reality is that's not generally how markets work. There's a winner and loser out of every transaction.
There's a buyer and a seller.
Yeah. So, you've got to think about it in those terms. Look at it as in, like we do with the macro, right? What's the CAPE ratio? It's 39. Whew. But Brazil's on a CAPE of 10. Oh, okay, well, I could invest in Brazil, right? If you go, I don't know what the CAPE is, I'm going to buy US stocks because they've been going gangbusters for 15 years, you're probably making a mistake because you haven't got the right information.
Yeah, well, right? You think about the returns in a random environment.
Yeah. And also that, I've been reading about NVIDIA all the time, I'm going to buy NVIDIA, right? Okay, well, is that important? Is that information important? Does it actually tell you anything about your returns, or are you just going, I read a lot about NVIDIA, so I bought NVIDIA?
Well, it goes back to last week's episode, which is the emotional or logical.
Yeah.
If you're emotionally reading all these articles about NVIDIA, you're going to get excited and probably...
Yeah. The media's job is called, there's a bias called priming bias. And so what the media does is prime you, right? So they get you excited about NVIDIA by writing about it. And suddenly you're laying there going... I probably should buy some NVIDIA, because
what have you been thinking about it?
And that's what I mean. It's sort of subconscious, right?
Yeah.
You just generally, as I said, nobody in Australia gets out of bed and goes, you know what, I think I might buy an investment property, right? You do it because you read about it. Therefore, you've got to say, is that information I read about valuable?
You hear about everyone else doing it.
Yes, right? Everyone at dinner parties is talking about how much they've made in investment properties, all the tax deductions, it's all really great. That's where you go, maybe I should start thinking about it, right? You don't generally get out of bed and just out of nowhere go, oh, I think I might buy an investment property.
Yeah.
Right. And it's the same with stocks, right?
Well, we've got to think about the price versus what's the price versus what's the value. So anyone can make capital gains, but again, what's the price that you pay?
Yeah. Most people will talk about the price. They won't talk about the value. And that's why we harp on about the earnings yield, right? Because that tells you the value. Yep. That tells you what you are going to most likely earn, right, over whatever time frame. So if you think about, let me use property because it's probably easier. Every house in Australia is actually owned by someone, right? And they paid a price. So imagine, just for example, right, you come along and you get in the bottom of the bull market and you buy a property for $500,000. Then it goes to 1.2 million, right, over 10 years. I come along and I go, oh, Jacob, I love this property. I'm going to buy it. And I buy it for 1.2 million, right? You've made 700,000 less whatever, blah, 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 right? But you've done really well. Now, that property is still standing there. You owned it. It's now not yours. It's now mine, okay? Okay, so then I go, oh, the market falls, right? And then I go, oh, man, I can't afford this property. Now it's worth, 800,000, 900,000. You come back, right? I ring you and go, oh, man, there's property still. And you go, I'll buy it off you for 900, right? Now, there's been 2 transactions there. You've done really well out of both of them. But my point being, when you look at things, look at what someone paid for them. Right, because that's the price, but that's irrelevant. What you do is you need to look at the value, and to do that, you need to look at what's the rental yield, what's the dividend yield, right? What's the long-term capital gain as a base rate?
Yeah,
right. You need to look at those figures with a fairly cool logic, right? What you often find is people doing this, property doubles every 10 years. Really? Well, that's not how it looks historically, but that's how it's looked for the last 20, 30 years. In fact, it might have even been better, right? Perth property's gone up 80% in the last 4 years or something. Okay, do you really think it's going to keep going up at nearly double? Well, that's clearly unsustainable. Yeah. You'd be a real fool if you said, I'm going to put in 20 years worth of doubling every 4 years. Okay, that might be a little bit ambitious.
So look at what it can yield. If it's an investment property, look at what the yield is.
Yeah, and that means taking in all the costs, right? If you are negatively geared, you are losing money on purpose, right? Because you're hoping for the capital gain. Excuse me. That doesn't mean you're wrong, but what I'm saying is you really want to know the difference between the price you're paying and the value you're getting as an investor.
Yeah, and that's the same for stocks, art, cars, property.
Absolutely.
Everything. So the price that you pay is not wealth.
That's exactly right. Just because you own something doesn't mean you're getting wealthy. It depends on the price you paid for it. Yeah. Right? So again, you need to delve into things such as cash flow, right? What's the long-term stream of? And this is where I think it's the next slide. Is it the next slide we're talking about?
Returns,
discounted cash flow, right? Which is generally the standard way of doing it. The idea is saying, Jacob, if you hold this property forever, the value of the property is in the cash flow that it delivers to you, right? Because you can never sell it, right? So that's where you ignore the capital gain.
Yeah, or the business that you own, or the
yeah. And
it's
so
easy to think about it from a business perspective.
Yeah, that's why the income's important, right? Because you can't buy and sell your property, 30 times a year.
Yeah.
So you've got to look at the income component, which for stocks is a dividend.
Yep.
And which for property is, say, the rental yield, right? Then you've got to look at the capital growth. Now, generally, if the dividend is really high, it may be that the stock market said this company sucks, but it's still got cash flow to pay a high dividend, but it might be risky. Right? It's the same a little bit for property. If the rental yield is high, that means that you've probably paid a cheap price for it, right? If the rental yield was 10%, you'd be going, man, that guy mustn't have, that bought an income stream for a really cheap, right? Or if the rental yield, as you're seeing in a lot of places, is 2 or 3%, what you have to do is say, okay, they're really looking at trying to get a big capital gain because there's not much income there. So if I said to you, I'll give you a property or a stock and it yields 10%, right? Generally, 10% compounding is pretty good.
It's brilliant.
Right? So you wouldn't think, oh, I'm going to sell this thing, right? You'd be going, man, this thing delivers 10% clean every year. This is great. If you have a yield of 2% per year, you're really saying this is a not a really good investment on a discounted cash flow basis.
I'm expecting the price to go up and some sucker to buy
I reckon I'm going to sell this sucker for 1.5 million in 2 years.
Yeah, which is speculation.
Exactly. But it's also knowing the difference, again, between working out what the price and what the value is, right? And so that last point there, earnings must be sustainable, right? You got to look at the price and the earnings. Most people get sucked into the stock market on the booming price.
Yes.
And the same thing with property, right? And what we know is the more you pay, the less your return will probably be, right? Because you're paying more for a dollar of earnings, okay?
Yeah.
And so that's where I think it's the next one where this gives you a bit of a rough idea about how to do that.
So this is something that I think you run through in in well too. I think signal versus noise more in depth.
It's a general one, yeah.
Just general.
Yep.
Which is what we try and help with the week that was. We try and filter out the noise.
Yeah,
and give some signals.
So this is again, you can and should ignore any comments regarding the daily movement of the stock market, right? And the reason why is if you're investing for 10 years, whatever happens on Tuesday does nothing, right? It's irrelevant. The reason why is the movement is tiny and has basically zero influence, right? Okay, so let me demonstrate that, okay? Let's say you buy the ASX, right? And the corresponding earnings yield is, let's say 5%,
Yep.
right? Okay. Now, let's add 500 points to the index. So the index is no longer at 7,000 and yielding 5%. It's now at 7,500. Okay. Now, if you calculate the new earnings yield, it might go from 5 to 4.95. Okay. So a minuscule change. That doesn't mean anything. But people will go, oh man, the stock market went up a lot today. It's like, yeah, but if you're a long-term investor talking about yield, you look at it and go, yeah, well, it doesn't make any difference, right? Instead of getting 5, I'm now getting 4.95. In actual fact, what you're doing is saying, well, actually, now it's going to cost me more to get a yield.
Exactly. But if you're a trader and you're in and out in a day, then you
think that's great.
It's brilliant.
Right. And that's why Buffett says, if you're a long-term buyer of stocks, right, you want to buy them, you want them to be cheap. But he's saying cheap in relation to the value, right? I.e., what's the value? The earnings yield. So Buffett's saying when stocks are yielding 10%, as he says, reach for a bucket, not a thimble, right? Because they're yielding a lot, regardless of the capital gain.
Yeah. Yeah, a stock can be cheap and not be yielding a lot still.
Yes.
Which
so
is,
it's
I think,
just
where people get mixed up.
Yeah, you've got to look at the yields, which is two components, which is the income part and the capital gain part. What we see in the stock market in the next slide, we cut half this chart off, unfortunately, but what you see there is the differences over time of the return of the yields, right? And so that's why, and we use this chart quite a bit, because what we're showing people...
So the red line that you can't see is annualised real return.
Yeah, over 10 years, right? And so we talked about this I think in last session, where saying
2 sessions ago, yeah.
Yeah, where you look at 2000, the yield was really awful, but you'd had an 18-year bull market in capital growth,
Yeah.
right? So from 2000 to now, 2025, January, you've earned roughly about 4.5% compound, which is not that great, right? But if you bought in 2009 when the yield was really high, you've done really well,
Yeah.
right? And that's the really, really important point people need to know.
So if I sat on my bum for 9 years and didn't do anything and just earned a wage, saved money, and then invested,
Yes.
I
You'd
would
have done a lot better,
Yeah.
right? And this is our point about compounding and timing, right? Because what the broad industry says is, Jacob, just stick your money in and you'll get an average. Well, okay, but who wants to be average? I don't know about you, but I want to be better than average. So therefore, how do I do it? Well, I've got to do something differently, which is buy low, sell high. And then you say, okay, am I buying low? Oh, the yield's 1%. Okay, I'm probably not buying low. That's the way that you calculate it, right? So you've got to look at this stuff about expected returns.
And de-risking it, yeah.
Yep, okay. When you're buying at the top, you're putting in more risk. You're not de-risking, right? So
Look for stocks with a bond-like quality.
yeah, Buffett talks about that. Volatility eats away at your returns. Okay, more volatility, generally, if you don't
Know what you're doing.
yeah, you will lose capital gains, right? Because the price fluctuates a lot. If you can take advantage of it with rebalancing, which is why I talk about stocks being good, because when stocks fall a lot, you can buy more. If your property value falls, you can't buy more. In fact, you're having the opposite, right? So the important part is to calculate the income, the capital growth, be generally conservative, but also realise is, like I say, if I said to you, Jacob, you bought a property in Perth, oh, mate, you'll be doubling your money every 5 years. That's a really stupid call, right? Now, what's the answer? The answer is to say, let's just assume the long-term capital growth is 3%. Okay, well, let's use that figure now because I'm going to hold it for 20 years. Right, and you can't say over 20 years it's going to quadruple. Right, you got to say what's the long-term average. So it's equivalent to saying a guy who's 7 foot just walked into the room, and I'm going to use the next 20 years to calculate using that guy who's 7 foot. It's like, dude, the average is 5'10". You're better off using that figure.
But the next 100 guys, it is random, and I have no information on them.
Yes. So therefore, you're better off, though, saying I'll use the long-term average because that's generally what it's going to turn out to be.
Yeah.
Right? So...
In cycles.
Yeah, just again, as we said, if you can wait for the market to be really cheap, you'll do a lot better than just dollar cost averaging in, right?
Yeah, dollar cost averaging down to the bottom of the cycle is generally what people do because they're earning a wage and it's like a super fund, right?
Yeah, yeah. They don't know they don't understand the market cycles, and again, the finance people are like, oh well, you just keep putting your money in the market. And to me, that's like, well, that's really dumb.
Well, a good point is how long superannuation been around for now? Since the 90s?
Oh, yeah, 93.
And that's basically dollar cost averaging into a market. But there are not many squillionaires from super.
That's what I mean. This idea of, you just feed it into the market is really dumb because I look at it and go, God, even if you just learnt about market cycles, you'd be going, well, hang on, what am I putting my money in when the yield is 2%? Shouldn't I wait for the yield to be 10%? Oh, no, you'll miss out. It's like, really? Well, not according to those charts. We know market cycles, residential property, bonds, art, stock, gold, whatever. And if you can be strategic enough and patient enough to say, look, I'll just wait for the good yields. And yes, I know all my friends are going to tell me how rich they're getting in Nvidia, but they don't know what they're doing. They're just going to blow up. So if they know what they're doing, good luck. Go and follow them and ask them for advice. But if they're just a bit like, oh yeah, well, I'm just buying Nvidia because a mate of mine said it's a really good stock, that's where you can say, oh, okay. You can question people. What's the yield? How do you think it'll go? Most people, the information they got's pretty thin.
Yeah.
Right? It's a bit like, my brother-in-law bought it.
Yeah, as soon as you start digging down. I mean, even with some court experts, as soon as you start asking some awkward questions,
yeah,
you can't
yeah.
answer, so.
Well, there was one in Australia who I won't name, but was talking about individual stocks, right? And you could see they were booming, but partly because everyone was triggered by this guy to buy the stock.
Right.
And then 6 months later, he goes, oh, yeah, we sold out 3 months ago. And everyone's like, shit.
Next minute,
because it's gone from $10 to $7, right? And everyone's going, let's call him Bob. Bob, is this still a good? Bob says, oh, yeah, I sold out 3 months ago at $9.50. It's like, right, okay.
Told us to get in, but didn't tell us to get out. Thanks, Bob.
And that happens quite a lot.
A lot, yeah. Anyway, we'll leave it there for this week. Next week, we're going to talk about how to calculate an expected return as well, so stay tuned for that.
Exciting times.
Thank you, Stephen. Thanks, everyone.
Cheers, folks.
As always, remember, we don't provide financial advice.